All right.
All right. I'm gonna start letting everyone in.
Let them in.
All right.
All right.
Happy Monday, everyone.
Yeah.
We're
Happy Monday. Happy
letting everybody
Monday
kind of
it
pop
is.
in here for a few, give us a minute or two and get everybody in the
Yeah.
group.
Well,
I just got back from the College World Series in Omaha, Nebraska. It's a little different weather there. It was fun though. It was hot.
Yeah, I bet it was.
Medium
Those
air.
aluminum bleachers are hot, man.
Yeah. Here's a
All
poll
right.
that just popped up.
Everybody, hey, everybody mute yourselves when you come in. Elvia, make sure they're all muted, or just mute anybody that comes in so we can minimize the background noise. If you have a question, you can surely raise your hand. We're going to go through Q&A first, and then any other questions, we'll jump into that. We'll just, talk about some of the stuff that we have going on. So big week this week with our annual masterclass, Eric. I mean, we only do this once a year, and this year is really, the timing of this couldn't be any better just because of all the changes we've got going on in the market right now. I mean, it's the perfect storm. It really, really is. I've literally been waiting for this day since 2012. I can't tell you how excited I am. It's just, it's awesome. People are all panic in the streets. It's like, oh my God, the sky is falling. The sky is falling. Well, it may be for some, but for the smart ones that are on the inside and understand how to use it to their advantage, it could be, this could be a 1 in 100 years kind of a situation. I mean, it really could. Maybe
Like
not
how many times
sure.
how many times has a performing note dropped 50% in your career?
I don't know. I have no idea what you're talking about. I've never had that happen.
I'm just asking. I know, that's what I'm asking.
Why? Well, first of all, who gives a shit if it does? Because guess what I have? The property is collateral.
Yeah.
So who gives a rap?
Yeah.
I mean, I care, but I don't care. You know what I'm saying?
No,
How's crypto treating you right now, Eric? How's that crypto that you own treating you?
Hold on. I don't own any crypto. Thanks for asking. But I might buy it now. I might load up on it now.
Everybody goes, well, why aren't you buying it now? I go, because it's not over yet. Hell, it could go to zero.
Some could.
Anybody think crypto could go to zero? Serious question.
Yeah.
Does anybody think there's a chance crypto? Put it in the chat box. I'm just curious because everybody that's a crypto expert, I would love to see their opinion, because obviously they're going to say no. But I think there's a better chance of crypto going to zero than mortgage rates going back down to 3%. That's for damn sure. Mm-hmm. So anyway, I don't own it, so I don't care. Does anybody think the stock market could drop below 25,000 or even 20,000?
Yeah.
No, interesting. So I don't really have an opinion on it because guess what? I don't own, Eric.
Yeah.
Besides not owning crypto, guess what else I don't own? Stocks. You know why I don't own stocks? No one ever asked me why I don't own stock. My wife was a director of institutional equity for a Fortune 10 company, one of the largest banks in the world. Worked on Wall Street for 25 years. And I do not own one share of stock. Not one. Why would I want to own something I can't control?
Right.
The reason why people own stocks, there's nothing wrong with stocks, by the way. Nothing wrong with bonds. My mom and dad have CDs paying them a 1.5%, and inflation is at 15. But you know what? It's their money. I say, do whatever you want to do, mom and dad. I'm going to get it all when you're dead and gone anyway. So blow it or keep it. I don't really care. It's okay. But the reason why most people invest in those things is because they don't know the alternative. That's why it's called an alternative investment strategy. That's why you don't learn about this stuff from financial brokers, financial advisors. How many financial advisors sell mortgage notes to you in a portfolio? Zero. You know why that is? Because they don't have it as a SKU, as an item number. It's not It's
So-
not Main Street or Wall Street.
Some of
That's
my biggest private investors are financial advisors.
Absolutely.
They lend, some of my biggest investors are financial. They lend me their money. They go make money on their fees in their business and they lend it to me because they want one thing. They want preservation of capital and they want monthly income. That's what they want. And so guess what's preservation of capital could be more important now than ever than
I would
what's
think so.
going on.
Look,
Yep.
now it's about preservation more than it is about earning, right? I mean,
Yeah.
everybody wants to get good returns. Good. Look, everybody wants high returns on their investment. However, there's risk associated with return. There's risk with everything that we do.
It's
right?
like when we talk about going and buying notes. If you're buying not note creation, we're talking about note creation, but when you're buying a note and people get caught up on yield, they're like, oh, I want to make 14, 18, 22% yield on this thing, but they just bought a piece of crap. And then it's going to take them all this time and energy and effort in order to do it. Where when the people
I
that
literally just sat down and had lunch last week with a very, very large note buyer that I don't know how many he has in his portfolio, but he's probably has hundreds. I don't think he has 1,000, but he's got probably in the mid hundreds, self-services them all. And I go, I don't want to say his name, but I go, hey, old man, because he's older than me, smart dude, right? Hey, one thing we have going in our favor is we have wisdom on our side now, Eric. You know, because guess who went through the debacle in 08 and 09? We did. 90% of the people that are on this call are in real estate in general today didn't get the privilege of experiencing the crap that we ultimately went
we
through.
made more money in the crash than we made in the when the market went up. We did well, but we made more money when the market leveled off and people got scared because we came in and solved a problem. And so
Is
that's
it fair
where
to
this
say,
is going to be.
is it fair to say, I know what my answer to this is. Do you think that you will make more money in real estate in the next 18 months than you have collectively in the last 5 to 7 years?
Yeah. I mean, hey man, we just plug along. We do our deals. We don't stress out. We're very, very, we're not flashy. We just it's a marathon. There's opportunities.
Yeah.
People are getting a little freaked out on selling their homes and they're liquidating. And what we do know is when that happens, there's opportunities for us to come solve problems.
Yeah.
And that's
which is going to be a big part of what we talk about in the masterclass.
Yeah.
On this Thursday, Friday, right?
Because all right. So we've been on for about 10 minutes now. I think we're with the majority of the people, obviously this can be recorded and it's on Facebook Live as well.
Yeah.
But
let me go back to I'm going to finish with a story about my note buyer, right?
Okay.
I go, what kind of yield you looking for? And he goes, I don't know, I like to get 15%. I go, well, I would like $1 million, but I'm not going to get that today. And I go, well, and I asked the question, I was a little more probing. I go, why do you want 15%? He goes, well, because there's always a bunch of work. I go, why is there a bunch of work? I'm asking the same question. He goes, what do you mean? Why is there a bunch of work? I go, why do you think there's a bunch of work? Well, because buyers don't pay and I'm self-servicing this. And I got escrows and taxes and insurance. I got to escrow taxes and insurance. Yeah. You go, well, no wonder you need 15% because you basically got a job.
Mm-hmm.
I go, what would it be worth to you if all you had to do was get a return on your investment? I go, 5%? He goes, no, I couldn't do it for 5. I go, well, I don't blame you. You're a smart, educated guy, but about 8. He goes, getting closer. My point in all of this is that when we create these notes and you do it the way that we say to do it, let me rephrase that. When I do notes a very specific way for one specific reason, and it's about velocity, it's about getting in and getting out and knowing that I have an asset that is highly desirable with little to limited competition. Okay. Just like we sell or finance properties to individuals and hardworking people that can't go down and get a bank loan from Wells Fargo or Bank of America or whatever. Guess what? Also, we have a limited supply of high quality notes that are written correctly. I'm not saying that people don't write notes correctly, because there's 50 different ways to write notes. But I'm saying is that write the notes that are desirable by more than less, because when you have an asset that's highly in demand, you can command a higher price. We talk about this all the time, Eric, that the national average 82, 83% of unpaid principal balance on a performing note. We're in the low 90s almost every time, unless it's a crappy market and a crappy property and a crappy borrower, right? And it happens because we don't follow instructions and underwriting.
Mainly the borrower and the property aren't in line.
We see it all the time on the deal submissions that people overestimate value.
Yep.
Right? They take down not enough. They don't underwrite the borrower significantly enough. And as a result of all those little nickels and dimes and quarters that we leave on the street, they add up to dollars. And that's why you're only getting $80,000 for your note instead of $90,000. And hopefully that's what we show. And we'll deep dive into that a little bit more in the thing, but that's the value of what we're showing is how to get maximum value, because you guys should be writing these notes, and you should want to write these notes as you're going to stay in these deals for as long as they continue to perform. That's what I do. That's all we're doing here, is just really, we're not telling anybody what to do. We're just telling people what we do and why we do it. I mean, you can go do whatever hell you guys want to do. I don't really care. I'll tell you exactly how I'm going to do it. If you ask the question why, I hopefully will give you an answer that you understand. So let's get into some questions, and then we can open it up to some forum and maybe do up a deal model or something like this. So first question is there a way I could secure my second position by using a first right of refusal or something? And I haven't even read these questions yet. So I don't like looking at questions ahead of time, because I always wanted to see if I can come up with an answer if I'm going to get stumped. So I don't look at them ahead of time. I literally just look at it. So I'm going to go back and start beginning. Eric, is there a way that I could secure my second position by using a first right of refusal? So I want to explain what a first right of refusal is, so that in the event the buyer defaults, I would have first crack at remedying the first position and or foreclosing on the buyer. Or does that right have to remain with the first position lien holder? Okay. You want to crack this one, or you want me to?
Let's break it down, because we have
there's a lot to break down on this.
we have a first lien and a second lien, right?
Yep.
Okay.
Which is what we teach, is what we do, right?
So what I think I heard there was the first lien, you sold the first lien and kept a second lien. So it's exactly what we teach. So what I think I heard was, I want to come back and have the first right of refusal to buy that first lien. And then in order, if there is a default or something happens, or this first lien holder, like in this market, freaked out. It was like, I'm liquidating everything and I just want to have cash, which could happen. And so now that note goes for sale, right? Or the first lien holder wants to sell the first lien, right?
Yep.
Is that right? So what they're asking is, can I get a right of first refusal on that first lien? So when the note that you sold it. So I have a first, I bought it, I sold it, I created a first and second, and I sold that first lien to Nick, and Nick's note buying world bought it from Eric's note buying world, selling world. And now Nick decides to sell, but when he sold that note, he gave me a right of first refusal to buy that note if he ever decides to sell.
I think the question is, in the event of a default. So in the event of a default, I can go pay, if I have the second lien and you're the first lien holder, Eric, guess what I can do? I just go pay you off. I don't have to ask you. I can go pay off that position.
If I'm the second lien holder.
Sure. And I want to protect my position as the second lien holder. There's nothing that stops me from going.
This is a default scenario, though. This is a default.
Right. I understand that. But he's trying to protect his position in the second lien holder. Right.
If there's a default. If there's a default.
So let's just say, sake of argument, first lien's $150,000, second lien's $50,000, property's $250,000. Okay. What's stopping me? And if I know what's going into default, let's just say I want that property back, or I think it's worth more. What's stopping me from writing you a check for $150,000 as the second lien note holder,
Yeah. Now
right?
there's, well, I mean, I mean, that
could
banks
do
do
it.
it all the time to protect their position.
100%.
Back in the foreclosure days, the second lien holders rarely
We're not going to do that because we
reinstated.
don't have to do that, right? But we can
Right.
we can go buy that position out from the first lien holder, right? That's the bottom line.
The best part is we're in second lien, so we're gonna know when there's a fault, and we're gonna go either work it out or
Well-
we can go buy the property from the.
Well, that's
from
my
the-
point is that if you pay
with
that
cash for
down, guess,
keys.
if you go pay that down, guess who becomes the first lien holder? Right now, there's some other stuff. I'm not going to get into details. You got to obviously, it's not as simple as doing that because you do have to have some cooperation from the seller of the note. But that's why it's super important when we structure these notes. Guess where the servicing is? Guess what the servicing is for the first and the second? It's at the same place.
Yeah,
Guess why we guess why we do that? Guess why I don't ever let the first lien holder move servicers without a penalty? Because I want to know that the borrower is making one payment for both notes.
right.
It's that simple. I want to
In
know.
in Texas, that's what you do with August
it
REI,
anywhere.
but you're
Do it
not
everywhere.
able to do that in every state with every.
1,000% we will do it in every state.
Okay.
I will. Maybe you won't. I will definitely do it because the last thing I want to do is break that payment up the borrower's making with two different servicers. That is a recipe for disaster. Recipe for disaster. Ask me how I know. Because I've sold notes, first notes, they moved them from different to a different servicer, and I didn't know that they were in default in the first lien position.
Right.
Because what they were doing is they were making a payment, the small payment to the second lien, which was me, was not making the payment to the first lien holder. That's a problem. Guess what happens? The first lien holder forecloses. Guess who I'm supposed to get notified as a lien holder. Do you think it always happens? Do you think it's always timely? No. That's why we want to know that kind of stuff, man. So the first right of refusal really applies the first right of refusal really applies when we sell the note and we make sure that the on the note side that when the note buyer that buys a note from us, that if he decides to resell it, that he gives us a right of first refusal to buy it back and meet or beat whatever the price is that he's looking to obtain on it.
Yep.
And really, here's the real reason why I want to know, I want the first right of refusal in it on a property or on a note is I just want to know what's going on. That's all. I'm not necessarily going to buy it back, but I do want to know that he's interested in selling it because maybe I can come in and cut him a little bit better deal. All right.
The other reason why our first lien holder, our first lien buyers, if we do sell our first liens, like us where we're at, is because majority of the time those guys are not going. They're not note creators. They want a nice, clean, passive loan, right? So what they like about us is in the markets we're in, we have a system and a process to exit out of these notes. So if there is a situation where it's a long-term problem from a note from a borrower where they're having a job loss, they're forced to move, whatever, they can't sell the property, whatever their situation is, and we can come along and help them, maybe give them cash for keys. They can deed the property over to us. We'll go resell it and then start the process all over again, because we'll just go create another note. I mean, because we're always marketing for buyers that need financing. So
Yeah, good. All right, let's go to the next question here. All right, it says, need some help finding a legitimate asset-based lender for a deal my partner and I have under contract. Also need some advice on how do you structure if we can't find one. Well, here's the deal. If it's a good deal, lenders are easy to find. If it's a bad deal, lenders are not easy to find, right? In our resources center, we have a couple of lenders. Obviously, it's very state specific. There's different lending rules and laws in each state. I don't know what state this is in. I can tell you what it is in Texas, but I can't tell you what it is in Ohio. But there's lenders out there. Now, what I will tell you, what we're starting to see is that lenders are they're tightening it up a little bit. They're not lending like they used to. They're a little bit more conservative now. Banks are becoming more conservative. Everybody is getting a little tighter. Well, so what? Go instead of doing a 75%, you know, the owner finance value, go down to 70%. The deals are out there at 60% anyway. Don't push this thing to the limit, man. There's no reason to. Just go find a deal. If it doesn't fit the model, then don't do it. It's just that simple. Guys, I see it all the time. People are so desperate to get a deal done. They violate the principles of what we were teaching, and all it is a recipe for disaster. Okay. Don't go buy freaking condos if the market isn't conducive to condo purchases. All right. Don't do it. It's not worth it. Don't go buy a property trying to make it an Airbnb if the freaking neighborhood doesn't allow Airbnbs. Don't try to put a square peg in a round hole. There's so much opportunity out there. I can't remember the last number. I think it's $40 billion of mortgages are 90 days later in pre-default right now. Guess what? Those people are going to be coming down the pike, and there's going to be an opportunity. And we'll talk about that a little bit more in detail in the masterclass as well. So let's go on to, here's the deal. I model it. If it's a good deal, you can get financing on. If it's not a good deal, that's the checks and balances that hard money lenders.
And that's why we created the modeling sheet for that exact reason. So if you can plug everything in.
Look, if you get $500, and we'll pull up a model sheet here in a little bit after we get to the questions. If you pull up the model and it gives you $500, it gives you a $500 a day per day profit, and it gives you a minimum of $5,000 in cash, and it gives you a total value of $25,000 to $30,000. It's a deal. If your numbers are correct on top, I'm not going to, you had to determine whether or not you really put a number in there for as his value. I just did one last week, and the guy put it in there at $230,000 as the sale price, which is the max ARV, but put no adjustment for repairs. I go, dude, it needs $30,000 in repairs. I go, you can't just give them no value for repairs. You've got to adjust it down. Even if it's a $10,000 reduction, it's still something that you have to put into consideration.
Nick, in your opinion, mine's a little maybe differ a little bit, but when we buy these houses at a wholesale price, okay, and we sell them retail's equivalent to what the owner finance value is, and we're not inflating it. We want to give the borrower an incentive, right? A break. And then we want them to actually go do the work, because the break that we're giving them is majority of the time is material, not labor. So now all of a sudden they just increase the price of their house. They have equity. They have a 30-year term. They have the ability to pay. They have the ability to pay. And now they have the reason why they're not going to default. It's a lot different than a rental property. That's why we don't.
Yeah, if you need to be a little more conservative, just discount a little bit more and then make it work. For example, I think I used 30. I don't remember what we used. I'm using right now, I'm probably going to shift it down to 40%. Okay. Because the buyers, it's becoming more of a buyer's market. So let's just say, for sake of argument, it's a $30,000 rehab, right? Everybody should be able to figure out what it's going to cost to fix it, to make it rental ready. Okay. I don't care about full on, granite and all that crap. I want it to be rental ready. It's all
the big things need to be in position so where they can go do nice cosmetic upgrades and make that a nice home for their family.
Let's just say it's a $30,000 rehab. Okay. In the past, I'd give them maybe a 30% reduction, which in this case would be $9,000. Okay. So 30,000, I give them 9,000 off the full market value, 221, give or take. Now I'm probably going to 40, maybe even 50%, and put them into a more competitive price point. So if I do, let's just say I go to 50%, okay, and you can choose whatever number you want. So 50% of 30,000 is 15,000. Take that off there. Now I'm selling it at 215. Okay, in this example, why is that important? Well, because we need a buyer to be able to buy. We have to have buyers that are motivated to buy. Besides, and price is one of the things based on value. But so what we have to do is we back into that number. Now we're setting that number at 215. Now we're setting it at 75% of 215. Now you're solving it in the model to get you to your acquisition price. So right now, as we shift into the buyer's market, we want to be a little bit more aggressive on the discount that we're going to take on the notes on, on the rehab side, which is going to force us to buy the properties better. Okay. That's it. And when we get to the model, we can show that. So let's go a couple more questions. And I think we have some questions in there too. So, let's see. If you haven't sold the first created note before selling the house to a new owner, how do you handle that if you still owe hard money? Okay. This question is probably asked probably more than most. Okay. So basically what we're doing, and I don't want to get into sub two. Okay. I don't want to get into sub two or seller financing. It's a whole different ball of.
But it can work the same as you're creating your exit.
Right. You can acquire any way you choose, but hard money, think of hard money. If anybody knows what sub two is, buying it subject to an existing date, an existing note, is hard money is no different conceptually what we're doing. We have a hard money loan already. Okay. We're going to take that hard money loan. Let's just say it's $100,000. Okay. And we're going to wrap it with our seller finance buyer, called a wrap mortgage. It's exactly what it is. And we're going to wrap that $100,000 debt, let's say with 100.
Let's just say it's 150.
150. Okay.
Let's say they bought it for 180. They put 30,000 down, and now you have now they owe one. Now
let's just go back and do simple math. Okay. Let's just say we borrowed 150. Okay. Hard money, 150. That's the hard money debt. We're selling it for 200. Okay. 200 is that, but that's not all. So we're going to take $20,000 down, 10% down payment. That leaves us $180,000. We're going to write $150,000 first and a $30,000 second. That first and second is going to wrap the hard money. Okay. This all happens. It's a wrap mortgage. You can disclose it any way you want to your lender.
And keep in mind, you're still on the hook for this debt, by the way.
100%. But that's why we do it. But then we're going to take that $150,000 first. We're going to sell it, hopefully around 90%. Okay. That means we're going to get 135 back. So 135 plus the cash that we got down payment covers the payoff, the hard money, and the remainder is what's left over. That's it. This all
and now when at the end result, this is why we love this, especially now in this market better than ever, is guess what we owe? Guess who we owe at the end of this? Nobody. We don't owe anyone anything. We don't owe hard money. We don't have nothing. That's all gone. Now that first lien holder took the risk for the note that we created for him, and now he gets paid or she gets paid that first mortgage payment. We get the difference and we move on. Does that make sense?
See if I can find that. So that's it. But there again, that's what the model does. Okay. We'll pull this model up here in a second and we'll walk through. I thought I don't have it on here. I was looking for something here. I'll pull the model in a second up. All right. So it says, Eric, can you sell a partial or a whole on the whole note? But the first and second does give you the options while you can retain cash flow. Do you put in the due on sale on the first? Do you put in due on sale and first right of refusal to buy the original first if he chooses to sell? We sort of already talked about that, right? Yeah. But I think the question is, can you sell a partial on the whole note? Absolutely. I mean, that's another advanced strategy, and it's a different buyer a lot of times, because most of the times partials are shorter term, but you're paying a lesser interest rate on it too, right?
I mean, you might get a partial buyer at 7%, 6%, and you sold it at 9.5%. So if you just amortize that out and they get, let's just use $1,000 a month as the payment, that might amortize out to 18 years instead of 30. But shoot, why if you got a partial buyer that's willing to do that, that's fine. And now, like, there's a lot of people out there that want that consistent cash flow secured to real estate, and they don't want their estate, let's say, to get lump sums of cash, lots of cash. They want to give their estate income. So there's certain note investors that love the strategy so they can, they know it's secure. They know I have preservation capital, and they know that they're going to give their estate income, not big chunks of cash. Although there's a time where that right of first refusal comes along, because now you get an estate that does sell, and you might have a couple $1 million worth of notes, and that estate might have 5 or 6 kids in it. And that estate, rather than get a few $1,000s a month, they want to liquidate and get that cash, right? So if they have the right to do that, that's where we come along, and we're able to buy it. We'll be able to buy that debt from them. Now, obviously at a discount, but it's whatever the market bears at that time. And that's why the right of first refusal is so important in pretty much anything that we do. So I don't know,
Yeah.
got a little sidetracked there.
No, that's fine.
What was it? Did you answer that?
Yeah, I think that was pretty close. I think we're good on that. Here's the challenge with selling a partial is this, okay? You got to first of all, you can't have underlying debt. Okay. You can't have underlying debt. So you have to take that note that you're in a partial, and you can take the proceeds from the partial, but you got to wipe out the underlying debt. You can't have the underlying debt there and partial. You can't do that. The other thing I don't do personally, and I think you probably can do it, I don't fractionalize anything. So I don't take a note. And there's other people that will say that you can do it. Great. But I'm all about doing things in a
That's more of a
conservative
security, in my opinion. So I think we both agree.
I don't like the feds.
That's the shirt you're wearing is similar to what you would wear in prison, I think. Is that a new?
It could be.
It's not.
I got the matching pants on too. Yeah, there's a little prison outfit. I didn't bring my headband.
That's close to what you'd wear in prison, but not quite.
It could be. Let's not find out if I need to have this when I go in, but I want to.
The point is there's ways to do it, but Nick and I like to keep it clean on that side and not create a security. So, but for me, I have notes that I own free and clear. I can go partial those out for 4 or 5 years, take some liquidity out, and go use it to buy more assets. So I do that a lot. I do that.
The challenge, here's my main challenge with partialing. Okay. If you understand how to partial, the challenge for most of the stuff that we're doing right here, conceptually, partialing would be the best strategy instead of selling the note. The problem with partialing is that you can't sell a big enough portion of it. You can't get a buyer to buy a big enough portion of it, typically, to get enough cash back out of it to wipe out the debt.
Right.
Okay. Partials are really good if you own a note free, like you could take your second notes, your free and clear second notes, and do that all day long and go sell a 5-year partial on the second. The problem is
those are great because guess what? You're borrowing it. It's a loan. So there's not
no
a
taxation.
Event.
No taxation on it. But when you have the first lien and you have that $150,000 debt, and you got to sell $150,000 of a 2-year of a $200,000 mortgage, you would have to sell that. Even if you could sell it at 8% or 7%, which would be hard, you're still going to have to sell probably 20 years of the 30-year term. Now, I would still do that. The question is, can you get a partial note buyer to do it? Because the chances are it's going to be harder. Is it possible? Absolutely. But you'd be better off just selling the whole damn note in their eyes. They rather have just control of it. So, we want to make this thing so it's consumable by the masses, because the more consumable it is by the masses, the more desirable it is. The more desirable it is, there's more competition. More competition equals more value, less discount.
But there's lots of markets around the country where you can get some pretty smoking deals where that partial does make sense. Because keep in mind, you have the second lien as your income. You got a cash flow from that. So I love the partial model. We don't really go into a whole depth on it because of the way we structure our deals. They don't line up, but it can be done.
You start accumulating enough second liens that are free and clear, might be something to look at. Because even if you only sold 50% of the value, it still would be worth doing it. And you take it.
Sure.
So I said, when you are interviewing servicing companies, what are the questions you ask? Okay. Well, the questions that you need to know: will you service 2 notes, right? Are you going to charge me double? Do you will you service a wrap mortgage? Because technically it's a wrap in the beginning. Okay. I mean, those are 2 of the main ones. How do you increase rates? What are your a la carte charges? Meaning, it's all servicers are great when the borrower is performing, right?
Right.
If a borrower is making their payment, there is
What's
no.
yeah, when they go into default, what do you charge for the default?
What do you charge? What do you
default
do?
collections?
How do I, what does that look like? Hopefully we do a good enough job of underwriting and it doesn't happen as often as it does for people that don't underwrite.
Mhm.
So, yeah, I think those are the main questions. I mean, I think those are the bigger ones. Do you have anything else, Eric, on that?
No, I mean,
Again,
obviously,
that's what our servicers get paid to do, right?
well, this is what we things are great when they're paying, but when they go into default and people aren't paying maybe they're not paying their escrow amount properly, and then escrow's not getting paid, or insurance and all this stuff starts happening. You just got to make sure that the servicers has the ability to help with that, but not charge an arm and a leg. I mean, you get charged $95 fee on a $250 second lien. Obviously, your investment, you have some issues on your return there. Now, keep in mind, with our second liens, we don't have any cost in it, so it's still a pretty good deal. If they're in default, though, that's where we would come along, because we created it from scratch. So we have the ability to help that borrower exit out if they need to. It's like I've always said, you have a short-term problem or a long-term problem. If we can figure out what the problem is with the borrower, then we can help them fix it. Those are some of the examples I've given. So,
all right, two more questions, and let's go to the chat, and then we can pull up. I'll pull up somebody's deal. I'll see who's on. Hey, Elvi, can you do me a favor while I'm going through these questions? Look into the deals that have been submitted. Well, let me ask you a question. Anybody that's on the call right now that submitted a deal that we have that's on here and they want to go through it, raise their hand and we'll pull that up. We'll try to get through 1 or 2 of them.
We got one. Ben Gonzalez says he has one here.
Okay.
So
do that. Go ahead. So Elvia, make sure it's in there and I'll pull that up in a second. Tracy Jennings asked the question, do we have to have done a deal already to attend the masterclass? Absolutely not. All I want you to be able to do is have something that you can input. So A, you understand how the modeling works. So B, when we deep dive in and we start messing around with it, it's just part of the requirements. Because guys, let me say this, it's really important. Okay. There's 3,200 people in our private Facebook group. Okay. There's no way in hell Eric and I can provide any kind of quality of service to everybody. So we have to have a filter that allows us to go through and work with the people that are truly motivated and are ultimately want to do what we're showing them how to do. So a couple of the requirements are to be part of the master class next week is that you have to be a paid member of our thing. We sent it out 1,000 times. If you aren't one and you want to be there, go to creativedealmaker.com/video. Somebody will post it in the chat if it isn't already, and do it. Then the second thing is, if you've been a member since before June 1st, you have to complete at least 30% of it. Eric and I differed on this. I didn't want to give anybody, look, my position was, if you want to do this and you're serious about it, do the goddamn the training so you can get full advantage of it. Eric says, well, let's just let everybody. And I go, not going to do that either. So a compromise said 30%. That's like literally 3 hours a thing. If you can't invest 3 hours, I don't want to answer a bunch of questions, nor does Eric, that can be answered in the training. We want to show you how to take the training and actually put it into the deals and get the damn deals done and get paid. It's just that simple, because the more deals you guys can do, and then you can partner with me and Eric, everybody wins. Because that's what we do best is putting all this together. You guys are the deal finders. We're the deal creators. And then we disposition and everybody wins. The whole point of it. So with that said, so 30, and if you just signed up or you're just signing up, we're going to give you a break. We're not going to require any, you don't have to complete any of the master of the digital class, but it's really beneficial you do. So you're not, because we're not going to go back and go to module 1 and go, hey, here's how we find the deal. Hey, here's what you should do. Here's how this is. It's going to be more tactical than that. So hopefully you can join. I know we got quite a few people already signed up. It's going to be really good. We're going to talk about stuff that we haven't even talked about in Office Hours Live. And be quite honest with you, we probably will never talk about it in Office Hours Live, just because the nature of what the topics that we're going to talk about, and it's advanced. And if you don't have the core foundation of what we're teaching, at least in, understood, it's like speaking Korean to a Canadian. Are you Canadian?
Yeah, I'm married. I'm
Oh, you're
married
married
to
to
a Canadian. I don't understand what
Does
they say.
does Teresa know Korean?
Yeah, I don't- she's not.
Probably not.
No, but I
Yeah.
don't.
So,
I don't
all right,
speak.
one last
Apparently, I
question.
don't speak Canadian very well.
No, yeah, I don't speak. What? I don't even. Yeah, that doesn't make any sense. All right, one last question. Jason Mead said, "Can I use my HELOC to acquire a property and still do the 2-note exit strategy?" I assume I just want to make sure. Look, I've said it once, said it a million times. It makes no difference. I'm gonna say it again. It makes absolutely zero difference how you acquire. You can acquire with cash, hard money. You can rob a bank, pay for it. No, I'm just teasing. You can use private money. You can use your IRA money. You can go get a bank loan. It doesn't matter. You can get, how you acquire is seller finance, sub 2. They all can acquire. How you structure and exit it is the one constant.
There's lots of people that have some liquidity. Let's say they have a couple $100,000, $1 million, like from their IRA accounts, and they want to go and acquire, create a first, second, sell, rinse and repeat, acquire, create first, second, rinse and repeat, and then just build all these second liens. And then now you're recycling, yes, you're saving on some hard money costs and some fees, which in this market, it's great. Why wouldn't you? Right. And then depending on your volume, but all of a sudden you start building this volume, and all of a sudden you're going to run out of your money pretty quickly. And that's when private money comes in. Right. So you can do both, but I mean, I do both. I mean, I use my cash as long as I can. When I run out, then I go get private money. Yeah. For all the financial advisors that I always ask my financial advisor, what's a return on how their first liens are working out in the stock market these days.
Yeah. Do they give you an answer?
I mean, they get paid. I mean, it's just the best deal ever. Their
Exactly.
returns they're very predictable. Yep. Very predictable.
All right. So I'm looking for, why am I not finding this? Oh, here it is. So I'm going to pull up some of the stuff here. So Gretchen, if you are on the call, raise your hand and I'm going to pull up your model and we can walk through it if you're on here. I think she was on earlier, but I want to make sure. We got a lot of people on here. Let's see.
Also, put in the chat when you guys are listening, like do these when we go through individual deals, so you guys can kind of see the process and see how Nick and I's brains work. Does this help you guys out a lot? Just put yes or no in the chat, just see if this is helpful, because I noticed that we get a lot more activity when we start pulling up a deal or no deal, and we just start looking through it and the way we would structure it. So I think that's super helpful. And you start getting on these calls on a weekly basis, you get some, and it helps for confidence too. Yeah. I mean,
yeah. Well, there's always something, right? So, well, I don't know what this one is. This is the right one. Let me go back over here. Gretchen going once, going twice. And if not, we're going to go to, I think Will Westbrook, you're on the call. If you're on there and we want to go through the model, raise your hand. Oh, there's Gretchen. Gretchen, can you do me? Hey, Gretchen, I'm looking and you said you had put 5 on here. I don't see any, I don't have anything in yours. I have your file.
Yeah, and to your chat, I just send you the one from Adam and Gretchen.
Okay, put it in the folder for me, please, so I can see it in the folder.
You're asking me or her?
I'm asking Elvia to put it where it belongs in the certification file folder. Okay, our main folder. So I am gonna go Will. So let me do Will first, then I'll come back to Gretchen and get to Adam. Will, are
Hello.
you on? Are you on, Will?
Yes, I'm right here.
All right, super. What's up, man? All right,
Thanks so much.
so, all right, so which, let's see, make sure we got the right version. Okay, good. Okay, there's some errors in here, but we'll click them up. But this is important to show, guys. I'm not a fan when we don't get everything right because I have to go back and fix it and change it. So we're gonna go through this real quick. Let me do a screen share. Do you only have one property in here, Will?
I believe I have,
mean-
what's the title of the spreadsheet?
Well,
Because
the
I had two
spreadsheet should
different.
never change, guys. Whenever you, so there's only one file in here. It's called Lebanon. Is that it?
Yeah, I don't know what she pulled up. It
Well, we only,
wasn't the
look,
one.
there, guys, this is real important. I'm glad we're doing this. You only need to send one sheet. You add tabs at the bottom. So I'm going to share the screen and I'll explain to you what I'm talking about here. So let me share my screen and then we'll jump into it. So let's share screen. Okay. All right. Can you guys see my screen?
Yeah.
All right. So here it is, Will. Okay. So right down here, okay,
Mhm.
you have Lebanon. So if you're going to add another property to this, all you do is go in here, excuse me, you go in here and click on it, you duplicate the master, okay?
Mhm.
Duplicate the master, it'll create another one at the bottom. You rename the master, the copy of it, whatever it is, 123 Main Street, okay?
Yes.
It doesn't ever change. This file never changes. It's always this up here, okay? This is always never changing. It saves to the drive. You can add 1,000 properties on the bottom. It's always going to pull up the same sheet. So you don't need to add another sheet because we'll never find it. So we have this one sheet for you, Will.
Yeah.
This is the one we have saved now. So anytime you're going to add something, you need to do on a sheet. Okay.
Okay.
Enough with that. There again, that's all in this tutorial video, guys. Okay. We can't help you if you don't follow the instructions and do it the right way because we don't know what you're thinking. So I'm going to go to Lebanon right here. Let's just go through it real quick. Okay.
Mhm.
And see what we got here. So I'm assuming these numbers are accurate. I'm not going to verify what you have here. Okay. So you looks like you're buying it at 118. Okay. Repairs needed. Now, are you planning on actually doing repairs on this?
No, yeah, no, that's I actually did this one a while ago. But knowing what you've been teaching as far as just transferring the repair costs to the buyer.
Okay.
So that's,
So,
I need to.
so
fix
was this
that.
205, the ARV with you doing that repairs?
Yeah, to get the
You would
top
have to
dollar.
do 20, you
Yep.
would do 20,000, $19,000 in repairs to get to
The
205. Is that
Yeah, the
correct?
top, yeah, the top of market. Yeah.
Okay. So if you change this down to, let's just call it 3,000, maybe you got to do some cleanup, then you're not going to probably sell it at 205. You probably would sell it. What would you change that down to? 195?
Yeah, I think in the training, you guys were saying like 30% of what it.
Yeah.
Yeah, give or take. I mean, let's just see what that is. Okay. So your comps is 205. That's good. ZHY, I'm a little, this is a little bit of a concern for me when
Mhm.
you have the Zillow value at 155 and the sale price at 195. Because what does that come out to be? That means 155 divided by 195. You're in the 80 percentile of that zip code. Okay. That means you're getting towards the higher end of the zip code. Does it mean there's not houses for sale that are worth that much? No, there are. That this could very well be one of them, right? But what
Right.
it tells you is that when you look at that, is that you're gonna have to take that into consideration. I would much rather it be on the other side of the curve, meaning I would much rather say the ZHVI be 195 and we're selling it at 155. Make sense?
Yes.
There's definitely houses that are probably $400,000 in that house, but the higher you get up top of the mountain, less people are going to be interested in it. So we're not going to go through that too much there right now. So let's go down here. Let's just look at the numbers. Okay, so based on these numbers, if this is accurate, the first thing I want to look at is I want to go to these three things. I want to know what my minimum cash now is going to be, my total cash value between the second lien and the cash. I want that to be minimum 25. I really want this to be I really want this now to be minimum of 5. Minimum 3 is fine. But we really want to probably push a little more in case we're holding it a little longer. And then minimum cash profit per day, 645. So it meets all three of those pieces. So on the surface, this looks like a green light deal. So then the next thing I want to do is I want to go up here and I want to see where you are in the note value and this. Okay.
Mhm.
So this is where it gets a little bit tricky, because the question is, how much cash do you really want and how much cash do you really need? Okay. Because if you push this number, the higher you push this cash number, the more chance that you have to give a bigger discount because you pushed it too high. Doesn't mean you're going to lose money, just means you may lose the discount. So in this example, are you looking for as much cash out of this deal, or are you more interested in the cash flow?
I'm more interested in the cash flow, but I'm transitioning out of just a traditional wholesale model.
Okay.
So I do
So
need,
what I would say, could you get away with $5,000 in cash now versus 11,000 in this model?
yes.
Okay. So what I would personally do is I would come up here and I would change this note ratio and I'd lower it. Okay. Because what's going to happen when you change that note ratio from a 75% first, and I'm going to change it to 70%, what you're going to see in the model is this second lien number is going to go up. This cash number is going to go down. Okay.
Mhm.
So let's just change it to 70 and see what that does. Dropped it down to 27. Let's assume, for example, that this is what you were okay with this. So what happened is that now this second lien went up to $37,000 instead of 27. Okay.
Mhm.
Your net cash value went up to 40,000 total, right? Because you got a bigger second lien. So if I reverse this out, it goes down a little bit. The cash goes back up. So you're trading cash for second lien. Now, why is that important? Okay. When we do this, the real
cash
reason
flow.
why it's the most important, in my opinion, is because I have a lot higher probability of selling a 70% first lien at 90% and getting it than I am selling a 75%, because I reduce the risk to the note buyer, whether it's us, somebody else. Because now in this situation, let's look at the value of the first lien. At 70%, it's $136,000 face value that they're only paying $122 for. Okay. So
Mhm.
think of it from the perspective of the note buyer. So the note buyer now is going to only invest $122,000 to control $195,000 property in the first lien position. Okay. Would they rather put $122,000 against a 195, or would they rather control Z, or would they rather put 131,000? Right?
Mhm.
They're going to be more likely to pay a premium because they have less risk. Their investment to value is lower. The risk is mitigated. The asset doesn't change, but their investment does. And actually their return is actually going to go up because their return on their investment, their ROI, or their yield, or whatever it is, whatever term that you want to use, is going to be greater. Okay. It's going to be more attractive for them to buy. So that's going to in turn turn around and get it. Because what theoretically can happen is that we could write this note down here to say 70%, but we may get lucky and have the note value go up to say 92%, because the investment to value is lower. So they're going to pay a little bit more of a premium. These are all levers that go up and down. Now, what does that mean to you guys and when you're doing it? Well, when you submit these deals and we get them to underwriting before we underwrite the buyer, and we're going to talk about this in more detail in the master class on Thursday, Friday, is that we can come in and when you underwrite this buyer, and let's just say that you're okay with these numbers here, okay? 70%. And let's just say when we get that file and we do the preliminary approval on the borrower file, think of it this way. When you go in and you do loan application for anything, do they always give you instant approval?
No.
Never, not always, right? Sometimes they'll get back to you a couple of days later. Well, guess what? That's exactly what we're doing when we underwrite the buyer, right? We're going to have them fill out the application. They're going to go to the RMLO and we're going to say, okay, that let's just say for sake of argument, this is the deal we submitted. And they submitted $21,000 down payment and they submitted a 195 price. Okay.
Mhm.
And we qualified them. Okay. And we told them we're going to write, this is the deal that we're going to write. Well, now, once we get that, before we say yes to their application, we can take this data, this report that comes out, you can send it over and we can give you an indicative bid. That's the language that we use on the note side and say, we will pay you $125,580,000 for this note if you continue to follow the underwriting guidelines that we set forth. Because remember, underwriting the borrower is just one step. You still got to create the note, still got to close on it. The insurance has got to be right. It's got to be service, escrow, all that stuff still has to happen. So you can't screw that up, right? That
Mhm.
will affect the value, but let's assume that it is. And now you can come in and say, man, I really was hoping to get a little bit more than that. So you can come back and say, Mr. Buyer, I really need to change my down payment up, or I need to change my sale price up or down or whatever it is to make it work. Does that make sense?
Yes.
So those are your levers. So
Okay.
right here, I think this down payment's a little bit too high based on the repairs. I would want to probably, when I love to get 10%, but modeling at 10% is different than what actuality can be, right? This
Mhm.
is just this, all we are is forecasting this. So I'm going to say on $20,000 of rehab, that's going to be needed, I'm probably going to want to see this number probably a little bit shy of 10%, maybe like 8. This is our deal, right? We can structure it any way we want. We got to remember though, the note buyer is going to make the determining factor on what they're willing to pay. But I think in a deal like this, I think this is probably closer to $18,000 down.
Okay.
So now go back and check. So now you're down to 2521. And if you want that to be a little higher, then you're probably going to have to bring this up to 72, let's say 71 maybe. And now you got your model. Okay. Now you got your model. Now, the other thing you can do is what? If you want this, you can come and say, well, I need to go negotiate this a better deal, right? This is where people get hung up. They think just because the seller is asking a price, we'll go, this might make sense to do it at 115. Now what happens to my model? Okay. Well, now I go up to 74.40. Now that allows me to come over here and go back and do my 90%. And I'm okay with it there. So go negotiate a little bit better deal with the seller, right? That's it.
Mhm.
So don't try to force this right here. You have to solve it with, I would leave this at 90. If we get 92, it's a bonus, right? I wouldn't mess around. I wouldn't mess around with things like sales commission. Leave it at that 4% default. If you sell it yourself, guess what? You just paid yourself $7,800. Great. Okay. You
Mhm.
don't sell it yourself, you had to pay somebody, leave it there. All right. And use this as your thing. And then I would just continue to negotiate up here on this piece of it. Okay. That's it.
Okay.
So that's pretty much it. And then just keep negotiating it off that, this number right here. The yellow is the only thing you got to control. And then these things right here, these are your sort of your barometers on where you want to be. If you can get these three to be meet the minimums,
Mhm.
and you're at 90 here and below 75 here, okay, and your down payment is 10% or less. Remember, we want to be conservative, right? We're going to go ask for 15% down all day long, okay? Because guess what happens? I'm going to ask for 15% down, and let's just say I get $25,000 down here. Watch what happens when I do that. My cash just went up to $11,000 because I don't have to discount the cash. Now my second lien dropped down. That's okay, right? It gives us a better deal because the borrower has more skin in the game. But we don't want to model it that way. See what what you don't want to do is model it too aggressively, because then you have you want to model it with, I like to model it with inefficiency. Okay. What I mean by that is I want to model it with a high cost of selling the property. I want to model it with the borrower giving me less money down. I want to model it with a sales price that's maybe at or below market value. There's nothing that says there's nothing that says that this was the deal you did, that you can't come in here and ask for 205 and you can't ask for 220 and ask for 25 down. And you may get it 30% of the time. And that changes the whole outcome of the deal. There's nothing that says you can't change those, but model it conservatively, because that way you'll do deals that you know that you're going to make money on. Make sense?
Yes.
And I would not deviate from that, because, just like that, the market conditions could go down 5% on a sales price. And now you just totally, made it from being a profitable deal down to a, where you're deferring all your profit into the second note. Okay.
Hey, Will, do you
Yes.
control this property now?
No, it's
It's a model.
I'm still in negotiations.
Okay. Yeah, because right now what we're finding is on the disposition side is Facebook Marketplace has been a really good source of buyers. Now, as we see a market change, as we see interest rates go up, we're gonna see the seller. I think we're gonna see the seller finance buyer market explode. And now you get to cherry pick all your great borrowers, right?
Yeah.
So I think it's a great opportunity to do it. And El Paso, I think El Paso is a great market for it too.
Yes.
I agree. I think from what I'm seeing is people are open to doing that model here. And,
Oh yeah. Yeah.
All right. Thank you, Nick.
All right, cool,
Appreciate
man.
it.
All right, thanks, Sewell. All right, let's see here. All right, let me see if I got the, oh, he had put the other property up there.
And Stacy said in the chat, it's that getting accurate comps is 100% important on the sell of the note is really important. You can sell the property to a seller finance buyer for whatever they're willing to pay. But when you sell the note, that's where your good note buyers, the good note buyers are going to, analyze the properties and come up with their values. You want to be as close as you can to them. Yep.
Yeah. All right. So, Adam, I just pulled up your model. You're using an old model. So you're going to need to update and use the new model that we sent out about a month ago. Okay. If you have a general question I can answer for you, then you can ask that question, but you're going to have to go update it to model. Elvia, put the link to the new, the link doesn't change. It's still the same link. The model gets updated. So
It's
in
the private Facebook group. Yeah.
It's in the Facebook group. It's in the resource center. We made an announcement. We sent it out. Guys, make sure that you have it, because the formulas change. Okay. So it's probably not going to make that much difference overall, but we still want to make sure we're looking at it. All right, Adam, why don't you go ahead and ask your question, and then we can go from there.
I'm sorry about that. I already had that one. That's an old deal that just won't go away.
Hey,
Is that a good
that's
thing
what
or a bad
happens.
thing?
That's what happens in your pipeline. You're like, hey, here's my offer today, and if it doesn't work today, call me in a few months.
Well,
and then it might change.
They accepted my offer a while ago. I just I can get real close, but I can't quite get it there. Trying to do all of my money. All of my money is out in EMDs, because I kind of got scammed. I thought a whole bunch of money was coming my way, and so I threw all my money out. Anyway,
Well, did you post anything in the group? Anybody have looking to JV or partner on it? We got 32.
well, this particular one is it's in California. I got it for 165,000 under contract. It's worth like 400 and something, at least 300 and something. And we're trying to sell it for 297. it's within striking distance of Stockton. You know, people that live in Stockton could live there and be at work within within 45 minutes. So I know I'll be able to sell it, but I've been stringing these people along. So
I don't understand why you can't go get an asset-based hard money loan on this. if
well,
it's that good of a deal.
I can, but the closest I can get because of my bad credit is
Credit
they
has
want
nothing to do
20%.
with a hard money loan ever.
Then why can't I get the other
Well,
20%?
well, that's a great question to ask your lender, because a lender will lend you money if it's a good asset. He could give two rips about you as a borrower if he's truly a hard money lender. I know any hard money lenders on there. If you're really at those numbers, how much you buying it for?
165,
And what's the value?
like 400 and something thousand.
50% on the value at a conservative level.
I mean, it's
There's not a hard money lender on the planet that would not do that deal. If
Where are you? You're in California. You're in California. I mean,
this
you just-
one is in California. This particular property is in California. It's rural.
hey, if anybody's got any there's a lot of Californians on this call. I don't do deals in personally, but if you have any hard money lenders,
Okay.
that might
Yeah,
do
'cause
this,
I
because
just
there's
I
no,
just signed something that an extension again that'll give me a couple more weeks, but
how much does the
give
seller
him-
owe? How
I
much
have
does
to
the
give him
seller-
$3,000 by Wednesday.
How much does the seller owe?
I don't know what the seller owes.
Well,
I
you need
know
to
that
find
as
that
soon
out,
as-
because you can leverage the seller's position on this too.
Right. If they keep giving you time, then that means they don't have other buyers.
Why
on
can't
it.
the
So-
seller be the holder of the deficit that you can't come up with the difference in cash?
Well, there's two realtors in between us, mine and theirs,
So
and they would not talk to anybody that sent them,
guess what the realtors aren't gonna
anything
get?
less.
I don't-
But actually,
you're
they're
thinking of
talking
this
about
wrong.
suing me at this point because I've been
telling
stringing
you.
along.
Look, the realtors do not get paid if the deal doesn't go down. I can promise you that. They do not get paid a nickel if you don't close on this deal. They have to go find another buyer. If it was that goddamn good of a deal, they would have already sold it 10 times ago. Okay. So those are always flags. I'm not saying it's not a deal. I just don't know, but I would tell you this. If it was that good of a deal, then there should be no problem getting financing on this property.
Oh, it is a manufactured home.
Okay, that's fine.
Okay.
What year is it
How much
built?
land does it have?
It was built a year after the cutoff date. Good question.
1977 or something like that?
Yeah, 1978 or whatever. It's past that year so that we can repair it. All of the electrical was done up to code.
Okay. How much land is it on?
I think it's on an acre on top of the hill.
So is the value in the land or is the value in the manufactured home?
Both, but I'm going to put a new roof on it and fix it up. And it's just got mildew in it and a couple of holes in the wall or the floor.
Okay.
But I've already got a person that will go up in there and do it for me fairly cheap.
Right. And you've already because you were on a call a few weeks ago that you already built a pretty good buyers list for seller finance buyers too.
Yeah, in Indiana and now I'm building it in Arkansas and
Have you tried to sell this one yet?
Pennsylvania. I do have this one out there. I've gotten a few hits on it, but I need to put this one out on the MLS, I think, to actually get the real buyers.
Okay.
And I need to advertise it in Stockton area. I mean, if I just
but what my question is, why haven't you already started doing that?
money. I ran out of money, dude.
Well, you
How
can put it
about-
on
how about
Craigslist for free.
How about Facebook Marketplace and
That's where I've been. I've been putting it on Facebook Marketplace and
Okay.
And nobody's interested. Really surprising.
I have not put it on Craigslist yet. But like I said, the marketplace, I got like 4 different people that responded.
Nobody was interested.
The first one, it was a recent divorced guy, and I had it out there for $40,000 down and the payments were up there, honest, and he had no trouble with either of those. But I think he didn't call me back once he found it was a manufactured home or something.
Okay,
Or he might have driven out there, and there's a lot of manufactured home on the way
Sure.
up to it. So it's,
have you had it? I mean, yeah, look, I'm not trying to talk you into or out of it, but those are red flags in my world. When, if it's that good of a deal, hard money lenders will run to give you their money, because guess what? Hard money lenders have a hard time doing, lending money.
Especially on an asset that's at 50%. Or
Yeah.
better, you know?
100% correct.
Yeah. That's the biggest challenge right now in the market is we're in this phase where, you want to go make a deal happen versus just have a
Well,
deal.
if I tore the house down and rebuilt a really nice house, it would definitely be worth over 400,000.
Right. Well, we wouldn't advise you to do that right now in this market.
But no,
the time you said just I'm going to go build another house, you already
I
went and found a
could have done 30
deal.
of these. 30 of these, right?
right.
All right.
No, we're not
I'm just
doing
saying
that.
that
Well,
I think
we'll see if we
that
can
the
find-
land would be worth about $100,000.
Okay.
So we're probably
Personally, for me, I would. Here's. I mean, you've got the seller pissed off at you a little bit because you maybe didn't get earnest or whatever. I'd go back to him and tell him what you're doing, and just be upfront with him and say, hey, if I get a seller finance buyer, I'll close. If not, but I need 30 days to go do my job, and then I'll give you what you want. Maybe I'll give you another $5,000. I don't know. And
don't know
just
if you
tell them
don't
what you're
ask.
doing, because the agents don't know what they don't know what they're doing, and you do. So you have the ability. So put it off of them and let them kind of help you. Right. Now you have no risk. Now you have a 30-day run at it,
100%.
I mean, I do that back. Okay. So I guess it's been about 6 or 7 years ago. We had a little bit of a lull there, and I found properties that had really, really good terms. But they didn't have a whole lot of equity. So I went to the seller and said, listen, here's what I'm going to do. I'm going to sell this on terms to a lease option buyer or a seller finance buyer, but I need 45 days to sell the property. This is what I do for a living. And I provide home ownership for people. And then,
Yeah.
and with that, once I'm able to get it done, and his option, he didn't have anyone even giving them that option. So I went out and I ended up selling it in 2 weeks.
Yeah.
And that was it. And he was happy,
I mean, that's one of the things that we're going to actually go into pretty good detail in the masterclass. So,
yes.
for anybody that's there, we'll go in that on, because there's a huge shift that's happening right now on how we need to acquire versus how we want to acquire, right?
Mhm.
The way we used to have to be able to acquire is changing dramatically, and we control the hammer now. The sellers do not, in my world, as much I hated it when the sellers controlled the hammer before, but I still had to figure out a way to monetize it to make money. Guess who doesn't control the hammer anymore? The seller. Seller has no, and if they think that they do, I just say next. When you figure out that you're no longer in control of this and I am, then we'll all make a lot of money because I'm the expert here. I have no problem telling them that.
Well, and what about, I mean, I'm really not that afraid of this, but they're
How much money do you have into this deal so far?
They're threatening breach of contract at this
For
point,
what?
because I've been stringing them along, telling them.
Did you put up earnest money?
Actually, I haven't. I was going to
How
buy.
much was that? Did you put up an option fee?
I didn't put anything up yet.
So I don't know. So how much is the earnest money that you were supposed to put up?
They want $3,000 now.
They want 3,000. So
What did they want that you're in breach of contract with?
2,000, I think.
So you signed a purchase and sale agreement with a $2,000 earnest deposit.
Yeah.
Okay. But the price hasn't changed. Nothing's changed.
No.
I mean, you may be at a situation where you have to pay that. I don't know what the contract is. I didn't write it, I didn't see it, but
Yeah. What does your contract say? Does it give you an out clause? Or was that, or is it an MLS deal?
It was MLS. It was on, it was, I found it on the, my realtor brought it to me.
Well, is it a California Real Estate Commission contract?
Yes.
Well, I think California is about one of the most pro buyer states in all the states. So you really got to screw up the mess that one up. But you ask your buyer's agent, ask your agent what your situation is, or get somebody involved. I mean, you can't just drag it along. You either need to, like state of Texas, I think we have 2 or 3 days to provide earnest money to title. Otherwise, I think you could be in violation of the contract. That's why you want to make sure that you have an out.
Right.
Every contract you should have an out. When you sign a contract, everyone, and I'm not going to give you law or legal, but anytime I sign a contract, I control the deal. No one else controls it. I decide if I'm going to close on it or not anybody else. It should be that way for everything. You should be able to control it. No one controls these deals, but me. Okay. And I write it very clearly in the contract. And if they don't like it, then don't sign my offer. Don't take my deal. I don't care. This is not an emotional decision for me. This is a financial decision that I'm making. That's it. And and the last thing I try to do is try to force it. You know what? Because here's what happens a lot of times. They come back and they say, okay, where do you want to? Okay, I'll take your offer on that. I say, well, my offer's $10,000 less now. Sorry, you should have taken it the first time or whatever. But I think you need to go look at the contract and make sure that it is what you have. And you guys, whatever contract you choose to use, you want to make sure that you guys are controlling the hammer on these deals. That's simple. All right. Well, let us know, Adam. I'm not going to review a California contract, but your agent should have a really good understanding of that agreement. That would be the first person I would start with. All right.
We got Ben
Okay.
and John.
All right. Let's jump over to Ben. All right, Adam. All right, Ben, what do you got?
All right, hey guys. I sent over a deal sheet to you guys. I don't know if you got it yet or not.
Let me look here. Go ahead and why don't you tell us a little bit about it while I'm seeing if I can find it real quick.
Yeah, so it's actually one that we already took down. We had to close pretty quick. I got private money on it. 70K purchase price, funded for 75. So I'm basically no money in it right now. Best comp we've got. So it's in a small market, right on the border between Texas, Louisiana. It's in Texas. Got a comp at about 241 is what the best comp we found. It's actually almost an identical house, but it's a 1930s colonial style house, real, pretty big house. Needs cosmetic upgrades, couple of small plumbing and electrical things that need to be fixed. And it's actually got pretty good structural, roof and everything else. It looks pretty good. Foundation. So basically all cosmetic. I just want to run through the numbers, I guess, and see what you guys thought about.
So I don't see it in the folder. Elvie, do we not have it from Ben? I don't see it in the folder.
Yes, I'll try to the chat right now.
Okay, make sure they all go in the certification folder. Okay.
Yeah, it's already.
I don't see it in there. I don't see him in there.
I sent it about like 10 minutes ago.
Oh, okay. That's why we don't.
Yeah.
Have it. Okay. Can you add it to that folder real quick and then I can pull it out?
Okay, it's in there. Yes, and I put a link on your chat as well.
All right, I'll just go to the chat link. Hang on.
Yours as well, Eric.
All right. Let's
Okay,
pull this up.
thanks.
All right, let's do this here. All right, let me share my screen here. Okay. Share screen. Is it on Cold Quit?
Yes, sir.
All right, hang on one second. Let me share this. All right. So whenever you guys, the first thing you guys need, one of the things you have to do, you got to rename it up here. Okay, you can't leave it as copy. If everybody left it a copy, we'd never know who it was. Okay.
Gotcha.
So we want to,
Yeah, I had the old sheet, so I literally did
That's
that.
okay.
Right before I sent it.
Is it Z or S?
Z, yes, sir. Z,
2 Z's.
yes, sir.
Got it. Okay. There. Now it's there. All right. So Let's just go down. So this is Colquitt. Okay, there it is. Wascom. Where's Wascom? Is that East Texas, you said?
Yeah, east of Marshall, if you know where that is.
Yeah, how far east of Marshall?
It's, I'd say probably about 20 minutes east of Marshall and then literally a mile from the border.
Okay, but it's Texas, okay?
It is Texas. Yeah, it's a small town.
And you took this down with hard money?
Private.
Private, okay. All right, sounds good. So you have in here 120 days. Why did you put in 120 days?
Just because I guaranteed my private lender 4 months of interest. So I'm just kind of
Okay.
pushing it out the
That's fine.
furthest.
I'm just asking. I'd rather you
Yeah.
see 120 than zero, right?
Yeah.
Because if you
So,
beat-
so real quick, Ben, so on the, when you did private money, you got a $75,000 loan from a private lender. I'm assuming you did deferred interest because it's a flip per se, so that you owe them 4 months guaranteed. Is that right?
I went ahead and paid the 4 months up front.
Oh, you
but
did? Okay.
Yeah,
All right.
it's not deferred. No.
Got
Okay,
it.
all right, yeah. So some of the stuff we do, we'll get a loan and we defer the payments because we're paying them good interest and then we don't have to deal with sending them money because we're gonna flip it so fast that it doesn't matter. Most of them don't need the income, they just want the return.
Right. Yeah, I ended up getting a check at closing, so I just paid it out already.
Yeah,
Got
no,
it.
it's good.
Hey, what is the what was the rate you paid them?
10%.
Okay, so I would you would need, I would come in here and change the financing rate, because it's going to change it a little bit, because you already got it. So 10% is going to lower.
No
I think
points.
It's going to lower those down. No points. 0, because that'll,
Which for the group, when I do flips, I get 100% financing. I pay 10% and I do deferred payments and I do a guarantee as well. I think it's 2 or 3 months.
but you can change it in the model here.
Yeah,
Okay.
yeah. I'm just saying.
Hey, so a couple things, guys, especially in these secondary and tertiary markets, really, really important to do the ZHVI and the 12-month, okay? Because there's small, I mean, what's the population of Marshall? 30,000?
I couldn't tell you off the top of my head. It's small.
Yeah, so we need to know what these numbers are, because I don't know where Wascom is except where you told me. But we need to know, like, what does that look like? Let's see, what's the zip code? Because this is going to have a bearing on your ability to sell it, right? Also the desirability of the note buyer. So let's go. We don't have a lot of time, so we're just going to go down into the numbers and see, assuming that these all check out. So you go down here. So you got $15,000 cash, 37,000 total, but in profit per day is 314. That's okay, because you got 120 days in here. Okay. I mean, if this turned out to be, 8.7, instead, you're going to go up. If it was 60 days and you're at 710, you're probably going to be right on the number. Oops, Command Z. Let's see, disposition date 710. Why is it not putting the year in there? Give me 1 second. Well, I think I messed the formula up. Let me just go back. Let me just change this right here. I just want to see where it is. 7. Yeah, so you're fine. If you're in the 60-day, you're fine. So I'm okay with you doing the longer on there on this. It's fine. So I would say, what I would say on this deal, given the nature of where it's located, I would probably reduce this note ratio down. Okay. Because I would rather get all of my money and have it in the second note than discount it too much and have to discount the cash position.
Right.
Does that make
Yeah,
sense?
I like that. Yeah.
That's me personally. Now you can roll the dice. If this was in Dallas, Texas, or Houston, or a tier 1 market, you wouldn't have to do that. But in these smaller markets, it's just a less desirable asset. And so you want to make it such a good deal on paper, from a risk perspective, it's going to be better. So I would probably come in and I would probably want to set this to maybe 70%. And that drops that cash down to 84.75. Remember, this is strictly model. Okay. we're gonna try to beat it, but we want to just model this way. And
So
just
quick
because this-
question,
yeah,
by changing that note ratio, am I basically putting more on the second position?
exactly.
Okay,
So that's why this went up. So when you reduce it, because that 30%, think of it this way, the whole thing has to add up to 100%, right?
Yeah.
First lien, second lien, down payment.
right.
All three of those numbers add up to 100% of the sales price. So when you're giving a discount, you're only discounting it on the 70% of the deal, right? Instead, if you had a higher number, you're giving a bigger discount because it's a higher number. This is you want this, in my opinion, to be as low as you can deal with. Okay.
I mean,
Because the
quite
lower this
honestly,
is, the less discount you have to pay.
and honestly, as long as I can get enough money to pay off my lender, I want to get them out of the deal. I don't care. I'll keep what, and honestly, even if from an affordability standpoint, let's say I can't get $1,500 a month or whatever it is I've got there. If I need to discount my note interest rate wise so that it's more affordable for the buyer, I'd do that as well.
I think you're better off going to be doing something like getting $10,000 down and leaving it there, because that'll put more people in the thing. And then now you're looking at $3,500 here, and you're still getting a $35,000 second lien on this deal. It's a good deal. Because look,
I mean, your total P and I is only $1,200 a month. You're probably gonna add another, so for 1,500, they're all in, right?
yeah. I mean, we don't have the rent number in here, which is important because that gives us the value. I mean, any idea what rent is over in that area?
That's the thing. It's such a unique property because it's a big colonial house. There's nothing like it on the market.
Well, what's a regular rent? What's a better 2-bedroom apartment rent for?
From what I've seen, somewhere in the 900 ballpark, 8 to 9 for
Okay.
2-bedroom. I mean, this is a 4-bed, potentially 5. It's 3,600 square feet. So, getting somebody in that house at 150, it's a lot of house for 150.
And PITI all in for 1,500-ish a month. I mean, how do you have 2 families in there?
Yeah.
Maybe
Yeah.
3. So
Yeah, I mean,
I would say on this right here, I mean, if this model works for you, like deal wise, then this is how I would have modeled it. This is how I would model on the front side.
Mhm.
Okay. And then that, knowing that I'm okay with it. If I'm looking at these numbers, I'm not going to verify this stuff up here, assuming that it's accurate. Then I would come in here, because guess what? You can still come in. You could ask for 155 and 15 down. You can change this to 75%. You could change all of this. You might turn around and sell this thing at 155 and get 15 down. Do it all the time. Okay.
Have you started marketing it?
Today I was going to put it up on Facebook Marketplace, and so we initially got it thinking we're just going to wholesale it and maybe even a hotel. But with the market changing, I don't want to hold on to it for too long. So this is probably I'm gonna put it out both at a wholesale price if somebody does want to take it down, and then really honestly, I would rather just sell it like this, in this model. I think.
Yeah.
You're going to find out really quick by putting it out there and see what it is.
Yeah.
Okay?
Yes.
Call a couple realtors in the Marshall area. Tell them you have an off-market property. Do you have any people that are looking for financing, that are looking for a big whole house? You'll take, because in theory, I mean, you could literally take $8,000 down probably on this house and still be just fine. Maybe raise.
Well,
the
and
price
see,
a
that
bit.
was one of my
And
questions.
taking 8,000 is okay, just as long as that borrower has the ability to pay. That's important because.
Yeah, I
they're
get
just-
everybody underwritten. Yeah.
Yeah.
Now
You're at a
it's not-
70% first lien, because you think of it this way from the note buyer's perspective. Okay. They're going to be much more interested. Well, I can't speak for everybody, but I've done a lot of notes. I'm much more interested in what my investment the value is than how much cash the borrower put down. For example, in this situation, let's use this month. The buyer put $8,000 down, and I'm going to buy a note that is $108,000, and I'm only going to pay $97,000. I'm going to put the value that the value is 150. Okay, now I know what my risk level is as a note buyer. Whereas if you come in here and let's say I increase that to 10%, call it $15,000. Okay, And now you're asking me to give you 75% on that. Now I went up $13,000 or whatever that number is against the same asset. I like the investment but the borrowers got more cash in the deal. From a note buyer, what do you think is more attractive? I'm going to tell you what it is. They're more interested in what their investment, the value is, because that mitigates the risk. They already know that the buyer, even because you can't predict the future, but you do know what's going to happen in the event of a default. If it happens, I like my chances when I have only a 104. I mean, this is 104. I'm going to go back to what it was. So let's see what the difference is. 70%, an 8, 97. It's a $7,000 difference. But you got to really figure out what the yield is. The yield's probably going to be, I could figure it out. Maybe it's on here.
Well, that's what I was going to ask, because I didn't see the yield on the calculator. I mean, I could do it on the
Used to be right.
TPI,
Used to be right in here. We could do it. We could do it manually real quick. So the cash flow, it's real simple. So we're going to take first lien is 912. So let's see if I can do it over here in the margin. So equals 912 times 12 divided by this. So at a 70%, let me just format this so it's easy to see it. Okay, so at a 70% first lien, okay, with 8,000, hang on, is 11.21%, okay? That's the yield to the note investor, okay?
So that's
gonna go
cash
back-
on cash. Now, if I do the yield in my 10BII, what I notice is it comes out a little different.
Well,
Is there
that's
any
probably a
rules?
little lower because there's some principal being paid down.
So if I
Yeah,
change this
it
to
is lower.
75% and I get $15,000 down, okay? The yield, it's not gonna be the same. It's not, because the yield should be this number right here. 104, F41. I don't think it changed. Maybe it did change. Let's see. Let me go a couple more decimal points. Well, I don't have the calculator. I don't have the formula in here, but it's going to, the investment, well, the investment, the value is going to change. Actually, it's the investment, the value. The yield is probably not going to change. So anyway, it's just, look, I think what I'm trying to explain here is that the 75% is the maximum that we want to write that first lien for, period. Okay. If we had to, we don't want to write it for anything higher than that. We've already got
The reality though, it's still a really, really good yield and return for the amount of work people are putting into that first lien. That's, I mean, we're
yes.
talking decimal points here for the amount of effort they're doing to get their $900 to $1,000 payment, you know?
Yes.
So I've done those before. I'm new to you guys. Eric, I've heard you on a couple of podcasts, but when it comes to, I found buyers through Facebook Marketplace. I've done all this stuff from start to finish. I actually started a little TC business doing this for other investors. Going through like something like CTU, is that kind of, or should I go through an RMLO to, make this note more attractive?
Well, I mean, call the underwriter's fine. I mean, but an RMLO, I don't know. I think they're both, it's all showing the ability to pay, right?
Okay.
I mean, it's documentation. Nick might have a different result,
You just need to
opinion
have
on
it done. You just need to do it and make sure it's done right and it's in the papers, it's correctly done. And you just
Yeah.
want to make sure that whoever's doing it understands what needs to be done and how it needs to be done. That's why we recommend using the transaction coordinators, because they're the ones that are going to make sure that it gets that.
But it sounds like you're your own transaction coordinator, or at least you have the resources for it.
Yeah, I mean, I use Scott Horn in Dallas, and I service everything. I've got, I've done pretty much everything through CTU. I know Scott's got his own RMLO now.
Yeah.
So I guess if there's any pointers you have besides what I'm already doing.
Scott's pricey, a lot more money than.
Here's the problem. Here's the problem here again. Okay. Nothing. Scott, I've known Scott for 20 years. The problem is if you don't know the answer to the question and you don't know the answer to, is that he's not closing this with a title policy. He's not using a lender title policy. Okay. He's closing it as an attorney unless you tell him to close it as a title because he's got title too. Well, here's your problem. When you go to the assumption is that you're keeping this note that you're writing. You're not keeping the note that you're writing. Guess what you don't get unless you ask for it? You don't get the OTP and the LTP, the owner title policy and the lender title policy. Guess what every sophisticated, educated note buyer is going to want to have?
Yeah.
It's a lender title policy. You know,
So
how
I
many
didn't-
have you closed deals with Scott before?
Yeah, but
Did you have
not
lender
one
title
like this.
policies on them?
No, so the ones I've closed with Scott so far have been sub 2, which I didn't get a
Sub-2,
title
yeah.
policy on. Yeah,
Okay, so no title policy.
right.
So let's just say for sake of argument that you wrap those, okay,
Yeah.
and you put a buyer in it. Did you get an owner title policy or a lender title policy when you wrapped it?
No.
Okay,
And that,
now,
and
there's
that's
nothing
what
wrong with that,
we're-
by the way. There's nothing wrong with
Yeah.
it. But here's what your problem is going to be if you decide you want to sell that note. Say the loan gets called and you did a wrap mortgage, okay, or you just want to pay it off. Okay, now you're gonna go sell the note because you need to cash out of the deal. You're gonna sell the note. A note buyer's gonna look at that file and look at what you did or didn't do, and they're gonna come up with a value on it. Guess what's gonna happen when they don't see a lender title policy? They're gonna ask you to get a lender title policy. Okay, and when that's gonna add, it's way more expensive to add it after the fact. You can always add it, but it's so much better from a best business practices to put it in the beginning if you ever intend to sell. That's number one.
So you're
And
talking when you
right
wrap it.
now, and right now, when people are doing sub 2, we won't go into total detail about it, but they're not doing that. And then when there is a problem, because there will be a problem, they're not,
Scott Horn is
they
one of the
get
best.
crushed on the exit.
Scott Horn is one of the most knowledgeable people when it comes to this. Okay, but what I'm trying to explain is this. Scott Horn, or anybody for that matter, doesn't know what your intentions are. Okay,
Yeah.
he doesn't know what your intentions are unless you tell him what your intentions are. He's assuming that you're just going to sub to it and keep it forever and ever and ever and not leave you any flexibility on how you potentially want to exit. So if that's your intention, then you don't need any of that stuff. Because guess what? It's not a problem until it's a problem.
So to clarify, this one I closed through a different title company. I believe I
Okay.
did get an owners but I want to make sure are you saying you want a lender's title policy on the wrap?
100%.
On
That's
the
If
what
you're
exit.
going to sell the
yeah.
note,
Yes.
if you're ever going to sell
Okay.
that note, you're going to want a lender title policy.
When you sell it on terms, you're going to create a first and second, just forget about what you started with. And you're going to have a lender's policy in place for your loan that you created for yourself, but you're going to sell the one and keep the second, right? So,
Got it.
yeah.
Just about value. You can always change it later, but all you're doing is, look, we talk about, when we talk about the national average being 82, 83%, we're in the 90s. Okay. Guess why it's 82 to 83% and not 90? It's for stuff like this.
Yeah.
There is no lender title policy. It's not serviced by a third-party servicing company.
Yeah.
It wasn't underwritten. Taxes and insurance aren't escrowed, right? They didn't get 5% or 8% or 10% down. They got $500 down. All those.
Yeah,
things
they didn't
impact value.
underwrite it. They don't even know if the borrower has the ability to pay. There's no credit.
No.
There's nothing.
They take the payment as cash,
Yeah.
or crypto.
Okay. Makes
How's that
sense.
How's that working out for you?
Yeah,
Yes.
that's good stuff. Thanks, guys.
So anyway,
Yeah.
there again, it's okay to do any of that. It's just best business practices. Like I always say, what would a bank do, right? How does a bank underwrite a deal? What does a bank do? How do they do it? And if you follow best business practice in what a bank does, you'll probably in good shape 98% of the time. I don't want to say
Yeah.
always because banks do make mistakes too. All right.
Yeah, I mean, quite honestly, this is the first time I've heard about getting a lender's policy on a wrap. Scott's position is don't get it on a sub 2 because you're going to sell it, and basically because you're selling it, you're not going to. I guess you're not going to be protected anyway from the policy that you got on the purchase.
Well, there's a difference
You-
between owner title policy and lender title policy.
What's that?
There's a difference between owner title policy and lender policy. lender
Right.
title policy. Because let's just say you wrap it and you sell that note. Let's just say you have underlying debt of 100,000 and you write it for 150, okay? And you sell that note for 130. You're gonna have to pay off the underlying debt wherever it came from. So, because there's no way a note buyer is gonna be in a second lien position to Wells Fargo, right? So you're gonna pay that off with the proceeds that come in from the sale of that note. Well, so now the note buyer is in the first lien position. He's gonna want a lender title policy. Don't care what anybody says. Or he's gonna make you discount the note so deeply, you're gonna wish you had a lender title policy.
Yeah.
Right.
Yeah.
You know?
Okay. Sounds
That's
good.
it. That's all. All right. All right, guys. I think that's probably it for today. If you guys have any other questions, put it in the Facebook group. I'm gonna ask one question to John Stern, and then that'll be the end of it. I think everything's in the chat. Hopefully we'll see you guys on Thursday for the masterclass. We are
Yeah,
gonna
if you guys have
record-
not purchased it, please go buy Creative Dealmaker, the Academy, so you can be in the master class, because there's a high probability that everything that we're doing right now, there's going to be an increase, because we need to share this with more people. So we're building some infrastructure in order to do that, and everything's going to change a little bit financially.
here's
For
the other
you guys
thing
that are
that-
already in, fine, you're all good.
Well, we're gonna record it, but I'm not sure that how much of it, if all of it, will be made available even for the people that are there, because I'm not sure how far down the rabbit hole we're gonna go on some of this stuff, and a lot of it is opinion that we're gonna be talking about, and I don't have a problem sharing my opinion, but I don't want it to be misconstrued as something different than being my opinion. So, but we'll figure that out. So, last question to John. John, what do you got? And then we'll be done for the day.
All right, quick question. I don't know if my file's in your file. On a model, it was 575 Sunray. I don't know if that shows up in there. I did send it in. The basic question was, when I modeled it out, my cash now is coming in negative. I have no idea why. There's an $80,000 spread between acquisition and sale price.
Hey, Elvia just put it in the chat if you want to grab it, Nick.
All right, let me look at it real quick.
And I don't know if I'm doing something wrong. It's a kind of a hypothetical. It's a rental property that we own.
Mhm.
We bought on a 1031 exchange, and I would like to sell this on seller finance and get out of the landlord business.
That's why you're here.
Yeah, that's why I'm here.
All right, so this is the one on Sunray.
Yes, sir.
All right, let me share my screen real quick. All right, so let's see what you got here.
I have no
60
idea
days.
why my cash now is coming out negative on such a big spread.
Well, because you don't have any down payment in here.
I put in there 20 grand.
Oh, let's see here. Let's see
Yeah.
here. Not sure what happened here. Let's see.
Yeah, it's got a negative 8,500.
Yeah, and I'm sitting here getting all fired up, like, oh, we're gonna crank out.
You
some
got
money
50,
here.
you got 15,000 in repairs.
Right, well, that's about what we've got into it right now. Bought it for 162, put about 15 into it. It's currently rented out.
Would you sell it to your tenant?
I might talk to him about it, but I mean, the market's appreciated so much. I have a 2-year lease. He wants to do a renewal at 1,200. I mean, if I sell it on seller finance, I can make $2,000 a month.
Yeah. That's just on the payment.
Right.
So now you have no more tax insurance or any
Right,
of that,
that's
and you're getting
that-
net 2,000 a month.
I hear your voice over and over again that this is net. This is not.
It's really interesting how landlords are now coming to
Oh,
understand.
I'm all in, brother. I'm all in.
Yeah, yeah.
All right, Dr. Nick, what do you got going on here?
I'm just trying to look at it and see if it may not be, see 75. I don't know. I mean, it's just, it should, you're 177.55.
I've been staring at it for a long time. I was gotten really depressed looking at that negative.
I don't know. I would always go back and redo it again. There could be something in here.
Yeah, I would
Um,
delete, I would delete your spreadsheet, go back to the original master.
I'd go back to the master here.
Yeah,
and
and
we
let's
put-
restart over, because that's weird.
Yeah, because I'm looking at the numbers saying, I think I did it right.
I'd
Here,
go
why
back
don't
and
you,
make another
why
copy.
don't
and
you,
put it-
hey, Nick, why don't you create a new one and just have him tell you what numbers to fill
What's
in?
the, I'm just gonna do it quickly. Let me just make a copy of this. And then
Yeah,
I got a hard stop in 12 minutes. All
Yeah,
right.
it's all good. I mean, you don't have to do it. I thought maybe.
Well, I'll just
it
do it
was
real quick.
something
There's only
that I-
five,
let's
there's
do
only
it.
five, there's only 5 fields here. So let's see.
All right, you can yell it out. I probably know the number.
Hang on. Let me just rename it. Sunray 2. All right. Give me the acquisition price.
162, 15 repairs.
What's the sale price?
155.
No sales
Oh, I'm
price.
sorry, 250.
Repairs are 15,000.
Yes, sir.
What was your acquisition date?
Just do 60 days.
All right.
Like I said, it's hypothetical.
What did you put for down payment?
20.
and does it, with that little of repairs, I mean, I'd recommend at least 10%, but this is the lower end of it. Yeah, you're still a negative 12,000.
Yeah, I don't know. I don't get that one.
Well, you got a lot of expense in here. You got a lot of expense. I mean, you got a discount here. You got, you got marketing fee of $10,000, which is 4% of 250.
That's right.
Yeah,
I
I
think
was
it's-
looking at the whole thing and I didn't see anything where I really.
No, I
that
think it's
didn't make
right.
Sense.
No, I think it's right.
I just didn't understand. There's like an
But you gotta,
$80,000
here's
spread.
what you gotta, so here's the question now. Your net cash and second lien is still $30,000
Right.
because your second lien up here is $42,000. So the question you really, if this is what it turns out to be, are you willing to invest $36,000 to make it $42,500 second lien paying you $389 a month?
Yeah, I know you were talking about in other examples that if you get 2 out of the 3, is it worth it?
Well,
To
you-
get
and
that
you-
cash flow.
Yeah.
I mean, I think it's, it's,
So in essence, you're saying you don't see something that I'm doing.
no,
That's
I just did it.
crazy
It's
wrong.
pretty close to the same number. Yeah, I don't think there's any, none of this has changed up here. 12 and 9 and 2, that's still fine. Yeah, I think it's, yeah. When you get these higher dollars, you're having a bigger discount. You're paying more money on the fees. I mean, you can, if you market and sold that yourself, you end up saving yourself 10 grand. That's a
Yeah,
lot.
which
of
I
money.
probably would. I was just looking at the prior examples, even deal, no deal.
Sure.
Everything seemed to be coming out positive or close to it.
Yeah.
And I'm looking at this property going, there's an $80,000 spread here. Why is this?
You
not
can't
coming out
look at it
positive?
that, you can't look at it that way. This is a model, right?
Right.
There's a
right.
lot of other things that are built into this. It isn't that granular, right? The key to the thing is this is really what you're trying to achieve right here.
That-
Okay.
that,
If you achieve
cash-
these three marks, you got a solid deal. Okay. If you
Right.
don't achieve them, then you have to do something to get closer to it. Now, is this a bad deal? Well, depends on if you're willing to invest $12,000 to get $389 a month for the next 30 years. The
Right.
last time I checked, if you take 12, 8, 3360, 36, divide that by 389,
It's like
you're
28
gonna
months.
get all your money back in 32 months. Is that a
Right.
good deal? I don't know. Not a good deal for me, but it
Right.
could be a good deal for you because I can go do a better deal. I already know that. But
Okay.
did you already buy this? You said
Yeah.
Yeah, he owns it.
you already own it, right?
Yeah,
So
it's
there's
already
other factors.
listed.
Did it a 1031 exchange, there's some value there, right? So, there's other options you can do here. You might get,
When did you buy it?
2019.
Oh, okay. So so you're gonna get way and above your money back.
Oh, yeah, absolutely. Yeah, no,
Yeah.
it's just.
So this
it's
$12,000
just-
Oh, well, you know, well,
deal.
okay, well, if you already own it, then why do you have debt why do you have all the debt in here then?
It's just a hypothetical model, just to get
Yeah, just to
better
plug it
at
in.
going through the process.
Yeah, but
Based off what you paid and where you're at and the time, this works.
Oh, without
You're
question.
gonna sell it and
Oh,
you'll be
yeah.
able to rinse and repeat.
Oh, yeah, no,
But if
guys.
you were
without
gonna buy
question.
this, I would not be buying, I would, if this was the model, I would come back here and I would be coming somewhere more at 155 on this thing,
Right.
you know? And dropping that down. And I was saying now I'm at 5,500 now. What am I willing to do that? Probably so.
Yeah, no,
Yeah,
what
they-
was kept ringing in my head is that you had said on a, I think it was an office hours, that wholesalers have a line in the sand. And with this model, we can get over that line in the sand because they can't pay as much that we could pay.
Because of our seller finance buyer down
Right, that
payment
whole-
and
this
the
whole-
repairs that we're not gonna do.
Right, this whole model, and I was just confused, like, I was convinced I'm doing something wrong on this thing.
Nope.
The higher the price, as they said in the chat, the lower the margins are a little bit tighter when it comes to that, but your cash flow is more. It's really.
Right.
Yeah, because you gotta look at
second
it, you know,
lien.
you're right. So you mean, you're looking at a 37, you gotta think it this way. This
Yeah.
is the number you need to look at, this right here.
Right,
Because you're looking at it from the cash side of it. but You
right,
really need to be looking at the total value, in my opinion, of the cash in the second lien, right?
Mhm.
Because you can, let's just change this back to 20,000, okay? Now, it says that you're losing 55.45, but you're not losing 55.45. It just means you're investing 55.45 to do the deal.
right, okay, all right, yeah,
You're not
that's.
losing, you're just not getting the cash now. You actually got to pay cash now, right?
Mhm,
So what this is saying is that.
But you've already done it.
Right, right.
Well, I'm
this
just
is
using this as
hypothetical.
an example. So how many people would invest $5,500 to generate a $42,000 second lien at 389?
Me,
I can do it all day long.
Mhm,
I wouldn't go actively seeking these deals because if I only have
But we would buy it.
$100,000, I run out of
Yeah.
cash in 20 deals.
right, right, right,
That's the difference. Doesn't
Right.
mean it's not a good deal. It just means you don't get any cash now.
right,
Okay, so you get a bigger second note and you get 389 a month. So what? All right, if you really need the cash
but if
now,
you got $250,000 laying around and that means you could get for 289 times 50, that's gonna bring 50 deals. You'd get 50 deals. That's almost 15,000 a month with a $250,000 investment.
okay,
I mean,
but it's actually more than that because you're gonna get all your capital back in like
no, I get it. I'm
2 or
just
3
saying,
years. Then you
Yeah.
get all the back end free and clear.
if you
All
got
right.
250 laying around, go do as many of these as you possibly can until you're done.
yeah, no, we'll learn more and more on this. My concern was that I'm doing something that was, blatantly wrong. That's.
No, you're
my
good.
question.
All right. All right, guys. Well, thanks for
Cool.
the time.
See you,
Went a little
John.
longer,
Thanks.
but
All right,
Glad
thank
we
you,
did it.
guys. Appreciate it. We'll see you.
Hope
on
we'll see you guys
Thursday.
on Thursday. Have a good
All right,
one. Take
cool.
care.
All right. See ya. Bye.